Imagine opening your trading app and suddenly seeing Netflix share price looking completely different, dramatically lower than what it was just a few days ago. For a moment, your heart jumps. Did Netflix crash? Is something wrong? But then you remember the headlines about the stock split, and you start wondering what it really means. Did the price actually drop, or does it just look cheaper? And more importantly, does this create a rare buying opportunity? Or is it just market psychology playing tricks on everyone? That's the exact question investors across the world are asking right now. Netflix is one of the most watched stocks in entertainment, tech, and media, and whenever its price shifts, suddenly whether from a split, earnings, or market conditions, it grabs attention instantly. In the next few minutes, we're going to break down what's truly happening behind that new price, why it changed, and whether this is a moment to stay cautious, get excited, or dig deeper into the company's financial story. Before we dive into charts, valuations, and market behavior, let us set the foundation clearly so you know exactly what you'll gain from this video. Netflix isn't just a streaming platform anymore. It's a global entertainment powerhouse, tech-driven content studio, and one of the most influential players in the subscription economy. Its stock price doesn't move randomly. It reflects investor confidence, future growth potential, competitive pressure, and the company's ability to reinvent itself in a constantly shifting landscape. In this video, I'm going to walk you through the current stock price after the recent split and explain how to interpret it without falling for common misunderstandings. I'll break down what forces are currently influencing the stock, what financial metrics actually matter, and what investors, both beginners and experienced traders, should be paying attention to in the coming weeks. Stick around until the end, because I'll also share a simple, practical roadmap to help you decide whether Netflix belongs on your watch list right now, or whether waiting might be the smarter move. So let's start by getting a clear, simple picture of where Netflix's stock stands right now. After the recent stock split, many investors opened their apps and saw a much lower price per share. For some, it caused instant confusion. But remember, a stock split doesn't change the company's value. It only divides each share into smaller pieces, making them more affordable for everyday investors. So when Netflix executed its split, the per-share cost dropped, but the total market capitalization, the full value of the company, stayed almost exactly the same. This is important because it means the price you're seeing today needs context. It's not a crash. It's not a sell-off. It's simply a structural adjustment. To paint a full snapshot, a post-split price should always be compared to post-split levels, not pre-split ones. For example, if Netflix was trading at a high price before the split, that number gets divided too. So when you see the current price, remember that older charts may suddenly look different because historical data gets adjusted to match the new structure. This prevents misleading spikes and drops. Aside from the split, it's also important to look at recent trading volume. After splits, volume often jumps because the stock becomes more accessible to smaller investors. More people can afford to buy whole shares instead of fractions, which often leads to more trading activity. That alone can create short-term movement, even without major news. So right now, what we're seeing is a stock in transition, not because its actual performance changed overnight, but because the mechanics of its share price changed. Understanding this helps you avoid emotional reactions and focus on what truly matters: how the company is performing, how investors feel about future growth, and what the numbers say beneath the surface. Now let us talk about what's actually moving Netflix's stock beyond the basic math of the split, even though the share price adjustment drew the most attention. There have been several developments behind the scenes that play a real role in investor sentiment. One of the biggest ongoing drivers is Netflix's continued expansion of its content library. The company is investing heavily in global productions, which means more international shows, more regional partnerships, and more localized hits that help attract subscribers across different countries. Every time Netflix lands a major series or film that trends worldwide, it strengthens investor confidence in the platform's long-term potential. Another important factor is Netflix's strategic shift toward diversified revenue. Over the past year, the company has expanded into ad-supported subscription tiers, and the performance of that model continues to influence stock momentum. When reports show strong ad revenue, shares tend to trend upward because investors see a more sustainable multi-stream business model emerging. Netflix isn't just relying on membership growth anymore, it's building new ways to generate income from existing users. Competition also plays a huge role in stock behavior. Disney+, Amazon Prime Video, Apple TV Plus, and new regional players all affect how investors view Netflix's dominance. When competitors struggle or cut back on productions, Netflix often benefits. But when competitors report strong growth or major exclusive deals, Netflix shares may face pressure. External factors matter to general market conditions, interest rates, and tech sector volatility influence Netflix's movement because it's considered a high-growth, high-expectation stock. This means broader trends can lift or drag Netflix even without company-specific news. Together, these developments create a constant push and pull. The stock doesn't move just because of Netflix alone. It moves because of the entire streaming ecosystem. Investor psychology and global entertainment trends evolving in real time. Now let's break down the numbers that actually tell us whether Netflix is expensive, cheap, or somewhere in between. The most commonly discussed metric is the P/E ratio, the price-to-earnings ratio. This tells you how much investors are willing to pay for $1 of Netflix's earnings. Traditionally, high-growth companies like Netflix often trade at higher P/E ratios because investors expect future expansion. A high P/E isn't automatically bad. It simply means investors believe Netflix's earnings will continue rising. However, if the P/E becomes too high compared to industry averages or the company's actual growth rate, some investors begin to worry about overvaluation. One level deeper is the PEG ratio, the price-earnings-trade growth ratio. This metric adjusts the P/E based on Netflix's forecasted earnings growth. A PEG ratio around 1 is generally considered balanced, meaning the price matches the growth rate. Anything significantly above 1 might suggest the stock is priced for very optimistic outcomes. If earnings stumble, the stock can drop quickly because expectations were too high. Another key metric is free cash flow. Netflix used to burn cash for years due to aggressive content spending. But recent improvements have helped strengthen investor confidence. Positive free cash flow means the company has money left over after content production and operating expenses money that can be reinvested or used to stabilize the business. This is a core part of valuation that long-term investors watch carefully. Subscriber growth remains one of the most important indicators. Even if revenue rises, stagnant or declining subscriber numbers can trigger downward pressure because it signals potential limits to expansion. Valuation is ultimately a combination of numbers and expectations. The metrics don't predict the future, but they do show whether current optimism is reasonable or if the stock is priced as though nothing can ever go wrong. Every stock has two sides. What could go wrong and what could go right? For Netflix, both sides are unusually strong. Let's start with the opportunities. Netflix has built a global content machine that no competitor has fully matched. Its ability to launch shows that trend worldwide gives it a massive advantage. It's built-ended, and with new investments in advertising, gaming, and international originals, the company is diversifying in ways that open multiple revenue streams. If these areas continue to grow, Netflix could strengthen its position even further. Another opportunity lies in AI-driven content optimization using algorithms to predict audience preferences and streamline production. This could lower costs and increase hit rates over time. But the risks are just as real. The streaming market is saturated, and gaining new subscribers is harder than it used to be. At some point, growth may slow simply because the platform has reached most potential customers. When growth slows, high-valuation stocks tend to face correction. Another risk is increasing competition. Disney, Amazon, and other services are still investing heavily in content and losing subscribers to competitors, so failing to retain them can hurt Netflix's momentum. Content spending is another major pressure point. Producing global series and films is extremely expensive, and a few underperforming projects can significantly impact financials. If production costs rise faster than revenue, margins can tighten quickly. There's also regulatory risk. Different countries have begun pushing for local content quotas, new taxes, or stricter data rules. Since Netflix operates globally, even small regional change can have large cumulative effects. Finally, market volatility affects high-growth stocks more dramatically. If economic uncertainty increases, investors often shift money away from growth companies, which can impact Netflix even if the business itself is performing well. As we wrap up, let's bring everything into focus. Netflix's stock may look different today because of the split, but the fundamentals behind it remain the real story. The company is still one of the world's largest entertainment platforms, and its future depends on how well it adapts, innovates, and competes. Understanding the current stock snapshot helps you avoid emotional reactions. Knowing the recent developments helps you see what's driving momentum. Looking closely at valuation metrics gives you a clearer sense of whether the market is being realistic or overly optimistic. And considering both risks and opportunities gives you a balanced, grounded view of what might happen next. What matters now is deciding what kind of investor you are. If you believe Netflix will continue dominating global entertainment, pushing deeper into ads, gaming, and international markets, then today's price post-split or not might look like an attractive long-term entry point. But if you're more cautious, concerned about competition, slowing growth, or rising production costs, you may prefer to watch from the sidelines until the numbers become clearer. Either way, the most important thing is to make decisions based on facts, not reactions. The stock split doesn't make Netflix a bargain by default. It simply makes shares easier to buy. The real value comes from the company's performance, its strategy, and its ability to deliver content people around the world want to watch. If you found this breakdown helpful, consider sharing it with others who may be confused about Netflix's price changes. And if you want more updates like this, covering stock movements, company news, and financial insights, make sure to follow or subscribe so you never miss the next analysis. Until then, stay informed, invest wisely, and thanks for watching.